So the title of the show, 315, Investing in Retirement. We have to talk about this. I want to set the stage by looking at a couple of pages from my book, Sound Retirement Planning, and then I just want to have a discussion around some of the questions that people have as we talk about this idea. So just a couple of pages here, and then we'll get into kind of more of a free flow conversation. I subscribe to two different philosophies that can be combined for how you can invest your money in the stock market. Tactical investment management, which I call the art of investing, and strategic asset allocation, which I call the science of investing. We'll take a look at each of these below. I recognize that some people will believe strongly about one or the other investment style, so much so that they'll be unwilling to bend or see investing from any other perspective. For some, it's all or nothing. But I believe both of these styles are justifiable for different reasons. I tell our clients both are good investment styles, and depending on market conditions, different strategies may perform better than others. When it comes to clients' retirement savings and retirement plans, I'd rather be right 50% of the time than wrong 100% of the time. With the current extreme volatility we're seeing in the market, I'm recommending that our clients consider using both strategic and tactical investments as appropriate. In tactical investment money management, the managers are seeking opportunities and looking to avoid risk by actively trading and managing a portfolio, which means they will, at times, move your investments out of the stock market and into cash. This style of management, the art side of investing, it can't be academically or scientifically proven, but some managers have had very impressive results over a long period of time. Even though no guarantees exist that these results will continue into the future, you would be hard-pressed to discount what some of the tactical money managers have achieved. Strategic asset allocation. Strategic asset allocation was born through modern portfolio theory. Harry Merkowitz and William Sharpe won the Nobel Prize in 1990 for developing this theory. William Sharpe contributed the capital asset pricing model. We'll talk more about that in just a minute. In October 2013, Eugene Fama won the Nobel Prize for efficient market hypothesis, which is often associated with modern portfolio in the sense that efficient market hypothesis asserts that financial markets are informationally efficient, and one cannot consistently predict returns in excess of average market returns. Modern portfolio theory proposes how rational investors, key word there, rational investors will use diversification to optimize their portfolios, and how a risk asset should be priced. Modern portfolio theory assumes that investors are risk averse, meaning that given two assets that offer the same expected return, investors will prefer the less risky one. Thus, an investor will take on increased risk only if compensated by higher expected returns. Conversely, an investor who wants higher returns must accept more risk. The exact trade-off will differ by investor based upon individual risk aversion characteristics. The implication is that a rational investor will not invest in a portfolio if a second portfolio exists with a more favorable risk-return profile, i.e., if for that level of risk an alternative portfolio exists, which has a better expected returns, the rational investor will choose it. A landmark study conducted in 1991 and expanded in 1993 suggests that portfolio asset allocation is the most important long-term determinant of investment results. Strategic asset allocation also suggests that no one can accurately and consistently predict when shifts in market leadership will occur or how long they will last. The market leaders of one year often become the laggards of the next. Strategic asset allocation therefore suggests that it's important to spread your assets across multiple investment asset classes and sectors so you can potentially benefit from an upswing in any one asset class. It also suggests that the stock market is efficient and that all asset classes do not move in tandem. So the hope is that when one asset class zigs, the other zags. Because we are looking for balance between these asset classes. In 2008, when the market went haywire, this type of strategy didn't work very well. The only negatively correlated asset class were treasuries. Typically, when stocks drop, bonds increase. But because of the fear in 2008, even some high-quality bond mutual funds lost money in the short term. Many of those bond funds made a strong recovery once people got their senses back and the fear resided. The secret to buying low and selling high. Have you ever heard that the secret to success in the stock market is to buy low and sell high? Unfortunately, many studies point out that individual investors are fairly bad at timing the stock market. These studies suggest that most people tend to invest after a long and sustained bull market, and then they sell after the market has crashed. Essentially, they're buying high and selling low. What if a way existed to strategically buy low and sell high? Would you want to know about it? And when would you plan to implement it? One of the ways I believe you can intelligently invest in the stock market is to create a broadly diversified portfolio across asset classes and sectors, diversified across the entire globe. This method of diversification is what I call strategic asset allocation and is built by using low-cost index mutual funds or exchange-traded funds, ETFs. The powerful ingredient that really makes strategic asset allocation work is rebalancing the portfolio. Rebalancing is counterintuitive because it forces you to sell some of your winners and buy more of your losers. But if you believe that the market's efficient, then you believe that no one asset class or sector will ever dominate from year to year, and that eventually a regression to the mean will happen. So while large cap growth may be the best asset class this year, perhaps small cap value will be the best next year, and Treasury inflation protected securities the next. We don't know. Rebalancing is an intelligent way to buy low and sell high. How often should you rebalance your portfolio can and should be debated, especially depending on what stage of life you're in, if you're in accumulation mode versus distribution mode. But some people will rebalance a portfolio based on a calendar year of historical data. An old saying goes, sell in May and go away. But instead of selling, some will use this historical data to rebalance their portfolio in May instead. Depending on whether you have your money invested in a qualified or non-qualified account may impact how often you want to rebalance your portfolio from a tax planning standpoint. We set drift parameters for our strategic portfolios at anywhere from 2 to 3%. So any time one asset class has drifted out of alignment by more than 2 or 3%, that's an indicator for us to rebalance a portfolio. In summary, one way to make money in the stock market is to buy low and sell high. Rebalancing a portfolio that is broadly diversified across asset classes and sectors across the entire globe is a strategic, non-emotional way of helping you do just that. Many academic articles have been written on modern portfolio theory, efficient market hypothesis, and the benefits of strategic asset allocation. Many of the greatest minds in finance recognize these theories, and many would argue that they are the only way to invest your money. They have a proven track record and are used by many large institutions for managing billions of dollars. Both strategic and tactical investment styles offer advantages and disadvantages. Market conditions will determine which one of these styles will perform the best. In an upward trending market like we had from the early 1980s through 1999, strategic asset allocation will probably have performed best. And in a very volatile market like we had in 2008, tactical asset allocation may have performed better. They're both good, and as we said, I'd rather be right 50% of the time than wrong 100% of the time. Okay, so let's use that as a foundation now for having a discussion about tactical and strategic. So I want to start out addressing questions that so many people have right up front about active money management or tactical money management. Why would we want to include a tactical position and include what I call the art of investing? You're going to pay more money in fees and expect a lower return. But if you think about it, when you allocate money to bonds, aren't you also expecting a lower return? The bottom line is that investing in retirement is different than your accumulation years. When you're accumulating wealth, volatility is just noise. Let me say that again. When you're accumulating wealth, volatility is just noise. If anything, the volatility helps you. Hopefully, you're making regular contributions to your retirement accounts and your dollar cost averaging.